Hello everyone, I hope you guys are doing okay. Welcome back to another video lectures. So last time we already finished chapter 10 and so today we're going to start chapter 11, and this chapter is going to be the last chapters that will be before our next exam, right? Exam number 3. So exam number 3 we're going to cover chapter 9, 10 and 11, right? It's shorter than our usual, which is less material than our usual test, right? It's still gonna have 30 multiple questions, but the areas, the level, the volume of material is going to be much less, right? Because we will cover 3 chapters. So after I finish recording chapter 11, I'm going to create a review session video. So similar to last time, I'm going to give you guys a list of topics that you may want to focus on more. And I also going to provide some of the practice problems, to better prepare you guys for the third exam. All right, so I think exam number 3 is going to be on April 23rd, which we pretty much have like almost 3 weeks until the third exam. So please pace yourself appropriately. Don't, because we have 3 chapters and there's like almost 3 weeks until the exam. So, and I already posted almost all of the materials online. So I hope you guys pace yourself good. Have a good pace of following the sessions, the lectures, and I hope you guys prepare well for the third exam. And I'll try my best to prepare you guys. All right. So let's start with chapter 11. Right. So chapter 11 talk about property disposition. Right. So last time we talked about how we recover the cost of acquiring a property, or an asset. Right. So now we continue our discussion. It's like a flow. So now, in case some taxpayers want to sell their asset, then what's going to happen? So that's why we talk about property disposition today. Alright, so let's start. So property disposition mean the taxpayers or the businesses, right? They pretty much sell the properties, right? So in order to figure out the level of taxes or the tax outcome of the transaction, right, we first need to figure out the gain or the loss of this transaction, right? So the first part of the lectures we're going to talk about that, right? So in any transactions, we know once the taxpayer sell the property, right, he or she or the business, right? Let's say the business, because what we want to focus on here is business property, right? So let's say the business try to sell the properties, and in return, right, the business is going to receive either cash or some sort of property back, right? So it's a transaction, right? It's an exchange, right? So the business want to dispose of the properties, and in return they're going to receive something back, either cash or some other properties, or so something in exchange, right? So the amount realized is going to be that amount that they receive, right, in return of exchanging the property, right? So amount realized by the taxpayer from the sale or disposition of an asset is everything of value received from the buyer, right? Subtract any selling cost, right? So it should include everything of value. It should not just limit to cash, right? It can be cash, it can be some other property in exchange, So it should include everything. Subtract the selling costs that incur to the sellers. Right? So this is the formula, right? So the amount realized is going to equal the cash received plus the fair market value of other properties. Meaning, if the other party doesn't pay cash, or they on top of the cash they pay, they also throw in some other properties, in exchange for the property that the taxpayer is selling, right? So that's going to be the fair market value of the other properties, and plus the buyer's assumption of liabilities. So this part basically, so a lot of times the seller, right, they probably gonna take out a loan to acquire the properties, and then when they sell the property, if they haven't paid off the loan yet, then the seller, the buyer is gonna assume that debt, right, and the sellers who took out the loan in the first place going to be released from the liabilities, right, for the debt, right. So that's what it is, right. So the buyer's assumption of the liabilities from the sellers, right. Then subtract seller's expenses. So these are the selling costs, in case the seller, they may have to pay some commission fees to some third party, some middleman, right. So so let's look at one example to see, this is basic stuff, right. We all sell and buy stuff in our daily life, so we should understand this pretty clearly, right. So the question asks, so this company Titan wants to upgrade an old manufacturing machinery that is wearing out, and on November 1st of the current year, the company sold the machinery for $230,000 cash plus some marketable securities at the value of $70,500, right. And they have to pay brokers for $500 to fire buyers. So this is like a middleman, right. So the question asks, what's the amount realized from the sale of the machine, right. So to calculate that, right, we just follow the formula, right. We take the cash amount plus the fair market value of other properties in exchange as well, which is $70,500. So we take $230,000 plus $70,500, subtract any selling cost, right. So this here is going to be the commission fee paid to the brokers, and they pay them $500. So the amount realized is going to be the net of that amount, right, which is $300,000, right. So pretty straightforward, right. We should be able to grab this pretty fast. All right. So last time in chapter 10 we talked about depreciation of the asset, right. So over time, after using the machinery, the properties, the property is going to be wear and tear, and then the owners, the businesses have to depreciate or amortize or deplete the wear and tear expenses, right. So that depreciation or amortization or depletion that we talk about in chapter 10. And so after they depreciate, let's say in the case of depreciate, after they depreciate or after they recover the cost, then what the left over is the adjusted basis, right. So let's say the company bought the machine 2 years ago, and after 2 years of using, they depreciate, right. So the company bought the machine for $10,000, and after 2 years, now they depreciate the machine and for $2,000 over the last 2 years. So now the adjusted basis in year 3, right, starting of year 3 is going to be $8,000, right, because they already depreciate $2,000, right. So the adjusted basis is going to be that, right, that amount, the $8,000, right. So adjusted basis is the initial basis, subtract the cost recovery allowed or allowable, right, pretty much depreciation, amortization, or depletion, right. So in order for us to figure out whether or not the taxpayer recognize a gain or a loss, we have to use the adjusted basis, right, to as a basis, right. So let's say in the example that I just talked about, if at the beginning, after 2 years of depreciating, now in year 3 the company decided to sell the piece of machine, right. So they have to use adjusted basis to figure out the gain or the loss that they sell, right? So let's say adjusted basis at the beginning of year 3 is $8,000, and then they sell the machine for say $9,000. So the gain, they're going to recognize a gain, right. So $9,000 subtract $8,000 of adjusted basis, right? So the adjusted basis of the year of disposition is going to be crucial to determine the gain and the loss of the transaction, of the sale of the properties, right? So that's how we got the formula, right. So gain or loss realized can equal to the amount realized subtract adjusted basis, right. So this is the basic formula to figure out the gain and loss, right. All right. and here's like an extended formula, right? So gain and loss realized equal amount realized subtract adjusted basis, and then amount realized equal cash received plus fair market value of other properties plus assumption of buyer's assumption of seller's liabilities, subtract seller expenses, right? So this is the first formula that we just saw in the previous slide, right? And the adjusted basis is going to be equal initial basis subtract cost recovery deduction, so depreciation, amortization, depletion, right? So yeah, so this is just like an overview of how we get to this amount, how to get to the gain or the loss realized in the transaction, So, and here's just like some example. So we have the amount realized here. So this company, they probably sell a variety of properties during the year, and we have the amount realized, we have the initial basis, we have the accumulated depreciation. So with the initial basis and the accumulated depreciation, we know the adjusted basis, and then after we find out the adjusted basis, we can find out about the gain or the loss. Right? Take the amount realized, subtract adjusted basis. So just an example to show you guys. And here's another example. So let's see. So this company, they owns a computer, and the computer, as we know, is a 5-year maker recovery period. So the company purchased the computer 2 years ago for $1,200, and for financial statement purpose, the computer depreciates over 3 years using the half-year convention and straight line method with no salvage value. What are the adjusted book and tax basis for the computer? Right? So let's just ignore about the book purpose for now. Because what we want to focus about is the tax rate. So because the computer is a 5 years maker recovery period, right? And we know the firm already owned the computers for 2 years, right? So now it's on year 3, right? So based on those information, we can figure out the percentage rate, and we can find out about the depreciation expense for each year, right? So I'm not gonna go there. We already talked about that in the previous chapters. So in here, they already give us the depreciation amount, right? So say so it's 2 year depreciation. So year 1 is going to be 240, year 2 is going to be 384. So the adjusted basis of the beginning of the year in year 3 is going to be 576, right? So we already know how to do this, right, from the previous chapters. Alright, and then the question continued to ask us, what if the company sell the computer in the previous example for $400? What is the realized gain loss on the sale? Right, so we just take the amount realized, we subtract the adjusted basis, which is 576, and then we get the amount. Right? So in here, this company gonna realize a loss, right? Because they realized $400, and then the adjusted basis is $576. So in the end, they have a loss of $176. All right, so pretty straightforward, right? All right, so and then well, after the sale, right, the attacker had to immediately recognize the gains or the losses, right? Unless there's some deferral allowed, right? But other than that, majority of cases, they have to recognize the gain and the loss right away, right? So this we already know from previous chapters. Right, so whatever we just talked about is pretty basic, right? It's just kind of like a review for you guys to refresh on how to calculate a gain or loss, right? Alright, so let's talk about some of the special cases, to calculate adjusted basis, right? So as we know, when a business they acquire property, right? There are many ways that they can acquire it. So they can buy the property, or they can receive the property from someone, as a gift, right? Or they can inherit, right? The taxpayers, the owner of the business, may inherit the property from some family members, right? Or the taxpayers gonna convert some of the personal properties into the business properties, right? So that's happens a lot, right? Especially for sole proprietorship, right? And small businesses. So these are very common, right? So let's talk about how are we gonna figure out the adjusted basis for these cases, right? Because for example, like in the case of gift, right, we don't know the initial, because the taxpayer doesn't spend any money to acquire the property, right? So how we gonna be able to calculate the adjusted basis, right? How we're gonna depreciate, how we're gonna calculate the adjusted basis, right? So let's talk about that, right? So for the case of gift, right, since the taxpayer don't buy the property, right, because they receive the property from someone else, then the basis, the taxpayer basis in the properties is going to be depend on the basis of the donors, right? So there are two scenarios in this case, right? So if at the date of the gift, if the fair market value is greater than the donor basis, then the donee, which is the receiver, right, basis is going to be a carryover basis for the donors, right? So let's say at the end of the date, at the date of the gift, the donor's basis is $5,000, and then the fair market value is $6,000. Then the receiver, right, the taxpayers, the one who's receiving the property is going to be treat the $5,000 of the basis of the donors as his own basis, right? And why is that, right? It's pretty simple, right? So as you can see, the goal of the government, the goal of the IRS, the goal of Congress is to collect the objective of the tax rate. The government want to collect more taxes from taxpayers, right? So if they lower the adjusted basis, then it's more likely that the taxpayer going to realize the gain, right? And then they can charge more tax on the gain, right? So that's pretty basic. Right? So that's why when the fair market value is greater than the donor basis, the taxpayer should carry the donor basis to treat it as his own basis, right? Because it's a lower numbers, right? And in this case, the basis, adjusted basis, is going to be lower, and when the taxpayer sell the properties, he or she gonna recognize a higher gain, right? Right. So that's the first scenario, right? The second scenario is at the date of the gift, the fair market value is smaller than the donor basis. Well, in this case, the donor is going to use the carryover basis if the asset later sold for a gain, right? And if the asset later sold for a loss, then the donee used the fair market value as the date of the gift date as the basis, right? So again, as I say, right, if there's a gain, right, so let's look at this example. So we say, assume that Steve received 100 share of this stock from his grandfather on January 8. On the date of the gift, the stock was worth $15,000. Steve's grandfather original purchase of stock 10 years earlier for $10,000. So what is Steve's initial basis in the stock? And the answer is $10,000, right? Because this stock had appreciated in value while Steve's grandfather owned it, right? So at the date of the gift, the fair market value is greater than the basis right now, right? So that's our first case, right? The first scenario, right? So that's why Steve initial basis is going to be $10,000, right? Which is the carryover basis from his grandfather, right? And then the second question it asks, assume that on the date of the gift, the fair market value of the stock was $8,000. Then what is Steve's initial basis in the stock? So now it's a different case, right? It's the other case, right? So Steve's initial basis depends on the price for which he will later sell the stock, right? So he has to wait until he sells the stock to figure out what basis he's gonna use, right? So if Steve sells the stock 6 months later at the price greater than $10,000, his basis is going to be $10,000 carryover basis, right? And he will recognize a long-term capital gain, right? Because his holding period is 10 years and a half, right? And here's another thing I want you to pay attention to, right? So when it's a gift, right? When you receive a gift, the carrying period of the donors also carry over to the donee, right? The receiver, right? If it is a gain, right? And then let's say if he sells the stock 6 months later at the price of less than $8,000, his basis is going to be at $8,000, the fair market value of the date of the gift. And then he recognizes short-term capital loss because his holding period is only 6 months, right? So the carryover holding period is only applied when the taxpayers later sell the stock and recognize the gain, right? It doesn't recognize the loss, right? All right. And if he sells the stock for a price between $10,000 and $8,000, his basic to the sell price he gonna be no gain or loss. His basic is the sell price, and he recognizes no gain or loss. Right. And this is similar to another case that we're gonna discuss later, you know. But yeah, we're gonna talk about this in a little bit. Alright, so what we just talked about was the case when the taxpayers receive a gift from someone else, right? And use that gift to as a property, as a business property, right? So what happened when the taxpayer inherit the property from a family member? So in the case of the inherit properties, the heir basis, right? The receiver of the property, right? The heir basis in the property is going to be the fair market value of the property on the date of the descendant death, right? So this is pretty straightforward. It's just the fair market value of the date of the death, or there's another alternative date, right? Or it's going to be the date that is 6 months after the death of the family members, right? So if the taxpayer doesn't know, or somehow they because it's a tragedy, very sad day, or maybe their mind is not sharp, and they don't kind of remember what's the market value of the date, what the market value of the properties on the date of the death, right? Because everyone is so busy preparing for the ceremony, maybe, right? So that's why there's an alternative date, which is 6 months after the date of the death, right? To determine the fair market value of the properties, right? So let's look at this example. So it's assume that Steve inherited the stock from his grandfather on January 8th. What is Steve's initial basis if the fair market value is $50,000 and B $8,000 at the time of his grandfather's death, right? So it doesn't matter, right? It can be $15,000 or it can be $8,000. It depends on what is the market value, fair market value at the date, on the date of death, right? So if on the date of the death, on the date of his grandfather's death, the fair market value is $50,000, then it is $50,000. If it is $8,000, then it is $8,000, right? So whatever the amount is, Steve gonna take that amount and treat it as his basis in the stock, right? So this case is pretty basic, pretty simple, right? For inherited property, right? All right. So this third case is where it's a little bit it's going to get a little bit more complicated, and it's kind of similar to the first case, the gift case that we talked. So when the third case, when the taxpayer convert the personal properties to business properties, and let me correct myself, it's not personal properties, it's personal use properties to business use properties, right? Because we know personal properties in previous chapters mean all properties except for real properties, right? So I should use the word personal use properties, right? So depending on the fair market value, again, right, at the date of the conversion, then we have several different cases, right? So in the first case, says if the fair market value at the date of conversion is above the basis, the initial basis, right, then the taxpayer should use the basis for calculating the gain and the loss at its disposition. Alright, so let's look at the example here. Right? So in this case, it says Bill converts a truck with a basis of $5,000 to business use at the beginning of the year, and the truck is worth $6,000 fair market value on the conversion date. Right, so in this case, the fair market value is greater than the basis, right? And then later on, in the end of the year, Bill sold the truck for $7,000. So in this case, we're going to use the $5,000 as the basis for the truck, right? So Bill's going to recognize the gain of $2,000, which is $7,000 realized gain, subtract the $5,000, so adjust the basis, right? And that gives us $2,000, right? In this case, I assume no depreciation, just for the sake of simplifying the problems, right? Alright, so that was the first case, right? The second case, if the fair market value at the end, at the date of the conversion is below the basis, then the basis for calculating the gain or loss at the disposition will depend on whether or not the asset is sold at the gain or loss, right? So this is similar to the case of gifted properties, right? So if the basis for the loss is the fair market value at conversion date, the basis for the loss is the fair market value at conversion date, and then the basis for the gain is the initial basis, right? So again, similar to the gifted property, right? So let's look at the example. Maybe it's going to be clearer, right? So now it's consider that the truck's fair market value is $4,000 at conversion date, right? Which is less than the initial basis of $5,000. If the truck is sold for $3,000, right? So $3,000, meaning now it's a loss, right? You can see it's significantly lower than the $4,000 even, right? So we're going to use the fair market value of $4,000 as basis to calculate the loss of $1,000, right? Which is $4,000 subtract $3,000, right? So we use this $4,000 because there are, in this case, Bill, right? He's recording a loss in disposing this truck. So that's why we're going to use the fair market value at the date of the conversion. Okay. So if the truck is sold for $7,000, right? Now in this case, he's going to record the gain, right? Then Bill is going to use the $5,000 initial basis as a basis to calculate the gain of $2,000, right? So 7,000 subtract 2,000, subtract $5,000 is going to be $2,000 gain, right? So you can see if this is a loss, we use the fair market value at the conversion date. If it is a gain, we use the initial basis as the basis to calculate gain or loss, right? So that is in the case of if fair market value is smaller than the basis at the conversion date, right? So then, what if the selling price, right? What if the realized amount is like in between $4,000 and $5,000, right? So similar to the other example that we saw, right? This one, right? So in here it say if he sell the stock price between $10,000 to $8,000, his basis is going to be the sell price, and he recognizes no gain or loss, right? So this is exactly the same as as the our case in the converting personal use to business use properties, right? It is exactly the same, right? So I say in here, say if the asset is sold for an amount that falls between the adjusted basis for gain and the adjusted basis for loss, then the basis for the sale is going to be treated as the sales price, so the taxpayer does not recognize the gain or loss, right? And the example here is say if the truck that is sold for $4,500, an amount at between $4,000 and $5,000, then Bill should use $4,500 as the basis, right? And then he's gonna record no gain or loss, right? So yeah, so it all depends on the first of all, it depends on the fair market value at the conversion date, right, or at the receipt date, right? In this case, it all depends on the fair market value of the date that this property is transferred to the business, right? And then so depending on whether or not the fair market value is smaller or greater than the initial basis, then we have to find the right scenario to apply to our case, right? Alright, so yeah, so but again, it should not be that complex, right? It takes some time to sink in, to sink all this stuff in, but overall it should not be that hard, yeah, so I hope this, for example, I create this example. I hope it's going to give you guys a better understanding about this kind of problems. So, all right. So let's talk about the character of gain and loss rate. So after we are able to calculate the gain or loss of the property, right, from the gain or loss from selling the property, from disposing the properties, right? Then now the next step is to characterize the gain and the loss rate. So there are, depending on the holding period and depending on the use of the properties, then we can characterize the gain and loss into pretty much into six, as you can see here, into six groups, right? So first of all, let's look at trade or business properties, right? So properties used for trade or business. So if the holding period is less than 1 year, then the gain or the loss from the sale of these properties is going to be treated as ordinary, right? So if the holding period for this property is more than 1 year, then the loss or the gain from this property is going to be treated as section 1231 gain or loss, right? And we're going to discuss very detailed about this in a moment, right? So that was trade business. What about investment or personal use asset? So if it is a short-term holding period, if the taxpayer hold this property for less than 1 year, then the gain or loss is going to be treated as a short-term capital gain or loss. Right? If the holding period is more than 1 year, then taxpayer can treat the gain or loss as a long-term capital. Right? And then if the property inventory or account receivable, then doesn't matter the holding period. All the gain or loss can be treated as ordinary gain or loss. Right. All right. Types of properties, so first of all, let's talk about ordinary assets, right? So as we know, our ordinary assets, they are properties that are created or used by taxpayers in trade or business that are held for less than 1 year, right? And they also include properties that are used as inventory and account receivable as well, right? So the characteristic of this asset is that they gonna be taxed. That the gain and losses from selling this property is gonna be taxed at ordinary rate. So the say if there's a gain from the sale of these properties, the IRS gonna want the tax rate to treat this gain as ordinary income, right? Meaning they're gonna be taxed at whatever their personal tax rate at, which is much higher, right? Than say compared to say long-term capital gain kind of tax rate, right? So that was ordinary gain, right? And for the loss, again, it is ordinary loss, right? So the tax rate can just deduct, just use the if there's a loss, they can just use the loss to subtract subtract against ordinary income, which is pretty good, right? If they have a loss, right? Alright, so that was ordinary assets. Let's talk about capital assets. So from previous chapter, we already know about this, right? So for capital assets, again, they are assets that held for investment or for personal use, right? But the main point, the main purpose of this is to hold for appreciation in value, right? That's why I call investments, right? So one asset to one person, it can be treated as an investment, but to another person it may be treated as other type of assets and other type of properties, right? So let's say if you're taxed by a truck, right, for $5,000, and the main purpose of the truck is to deliver something, right? For this taxpayer's business, then this truck can be used as a business asset, right? And if the taxpayer holds the truck for more than 1 year, then if the taxpayer sell the truck, then he can recognize the truck as the 1231 gain or loss rate, 1231 assets, right? But still, same type of truck, but another taxpayer. If another taxpayer bought the truck for investment purpose, because these taxpayers think that maybe in the future the value of the truck may increase and he or she may recognize a gain. Then in this case, the same type of truck, but to the other taxpayers, it's going to be treated as a capital asset, right? And then when that taxpayer sell the asset, he or she gonna recognize gonna treat that gain as a long-term capital gain, right? If the holding period is more than 1 year, right? But yeah, so I just want to point out that there's no particular asset that can be classified capital asset. It all depends on the purpose of the asset, right? Why the taxpayer bought the asset in the first place, right? If it is for investment purpose, or for personal use purpose, then the taxpayer can treat the asset as a capital asset, and then maybe when the taxpayer sell it, taxpayers can treat it as a capital gain or capital loss, right? So here in this table, it's kind of summarize the characteristic of the gain, the capital gain and capital loss, for individual taxpayers and for corporate taxpayers. So for individual taxpayers, and for this type of taxpayer, we're already pretty familiar with, right? So if the capital gain of asset held for more than 1 year, the taxpayer is gonna be taxed the gain from selling the long-term capital from asset that held for more than 1 year is going to be taxed at the preferential rate, right? Which is ranging from 0 to 20%, but most people pay 15%, right? And then there's another type of capital gain, which is Section 1250 gains, and this is the gain for this is the real property kind of asset, you know, and we will discuss about that in a moment later, right? But for this kind of capital asset, of capital gain, the tax rate that apply to them is a little bit different, right? With the maximum rate is 25%, not at 20% as usual, right? But this is like a special case, and we're going to talk about that in a bit. All right, and if the asset have less than 1 year, then again the gain is going to be treated as the ordinary gain and be taxed at ordinary rate, right? And for loss limitation, we know the maximum loss deduction is $3,000, right? For capital loss, it doesn't matter if it's a long-term or short-term capital loss. It's going to be treated. The tax rate going to be able to deduct $3,000, right, from ordinary income, right? So we already talked about this in, I don't remember which chapter it is, but like a long time ago we already talked about this, right? So this, for individual taxpayers, I can say we're pretty familiar with this, right? What about C corporation taxpayers? So for corporation taxpayers, there's no preferential rate for them, right? All long-term or short-term capital gain going to be taxed at ordinary rates for them, which is 21% at the moment, right? So everything is going to be taxed at one flat rate of 21%. And then for loss limitations, so this is a little bit different, right? So if there's a loss, if there's a capital loss, the corporation cannot offset the loss against ordinary income, meaning they cannot deduct the loss, right? If they have a loss, they can carry back 3 years, or they can carry forward 5 years to offset the net capital gain, right? And to bring down the gain if they have any in the past or in the futures, right? But in the current year, they cannot deduct that capital loss, right? But that for C corporation, right? All right, so I just want to give you a brief introduction of the characteristic, and we already know about individual, but I just want to introduce you to the C corporation, how they treat capital loss, and capital gain. All right, so what about Section 1231 assets, right? So this one is a new concept, right? We haven't talked about this before. So again, if you remember the table I showed you a moment ago, right? So Section 1231 assets include assets for trade and business that are held for more than 1 year, right? And if the taxpayer sell a Section 1231 asset and they record a gain, then the net gain is going to be treated as a long-term capital gain, right, which is going to be taxed at a preferential rate, right? If the tax recognize a 1231 loss, then the net loss is going to be treated as an ordinary loss rate, which is pretty good, right? So they can offset the ordinary income and bring down the ordinary income rate. So as you can see, owning a Section 1231 asset kind of bring two two types of benefits, right? First of all, if you have a gain, then you'll be taxed as a long-term capital gain, right, which is at a preferential rate. If you have a loss, then you're going to be taxed then the loss can be treated as an ordinary loss, right, which also good for the taxpayers, right? So the taxpayers, I can say, if they own the 1231 assets and they sell it, there are two types of benefit for them, right? Either case, it's good for the taxpayers, right? So that's why taxpayers usually prefer to have Section 1231 assets. Section 1231, right, is safe tax at ordinary rate, right? Because the loss can be treated as ordinary loss, right? So it's safe tax at the ordinary rate, and then if there's a gain, the gain is going to be taxed at the preferential rate, right? So it's a double benefit. Right? That's why a lot of people likes it or want to hold this asset, right? So let's think about the case when the taxpayers have taxpayer bought an asset, and over the time that the asset depreciate, for let's say the taxpayer bought the asset for initially bought the asset for $1,000, and then after 2 years the asset depreciate to $800. The asset depreciate for $200, and then after 2 years the adjusted basis is $800, right? And then at the end of the year, the year 2, the taxpayers want to dispose this asset, want to sell it, right? And the taxpayers sell the asset for $1,000, right? So now, as you can see, even though the asset still was $1,000, but because of the depreciation, right, the cost recovery during 2 years, the taxpayer is going to receive a gain of $200, right? So this gain is purely created by the depreciation, right? The value, the market value of the economic value of the asset doesn't change at all, right? So all the gain here is created by the depreciation, right? So that in that case, the gain itself is generated by depreciation, and it's going to be taxed at preferential rate, right? Which is kind of unfair to the IRS, right? Because while the preferential rate, the long-term capital gain, the preferential rate is only applied to long-term capital gain, which is treated for appreciation in value, right? So, but in this case, there's no appreciation, there's no increase in value, there's no increase in the economic value of the asset, right? It's still worth $1,000, but because of the depreciation, right, they can record it again. So this gain is not created by appreciation of value, it's created by the depreciation over the recovery period, right? So that's why the IRS, the Congress, they don't like this kind of scenario, That's why they design a program to kind of prevent this, to fix this situation, right? So that's why we have a depreciation recapture program, right? So how does this work, right? So it works exactly to prevent what I just talked about, right? So this rule, right, which is called depreciation recapture rule, let's call it that, right? So this rule, what it does is recharacterize the gain from the sale of the 1231 assets, right? So basically, whatever gain created from depreciation is going to recharacterize that portion of the gain as ordinary gain, and that portion of gain is going to be taxed at the ordinary rate, right? And then whatever leftover, if there's a remaining portion of gain after you take out that portion of gain generated from depreciation, if there's any remaining gain, so this gain is going to be from the appreciation in economic value of the asset, and this remaining gain is going to be taxed at a preferential rate, at the 0, 15, 20%. Right? So that is the basic idea behind the depreciation recaptures rule. It's just this rule is created just to recharacterize the gain, to recapture the gain that is generated from depreciation, and treated that as the ordinary gain, right? Basic as simple as that, So let's look at the how we can apply this depreciation recapture rule, So under section 1231 assets, there are 3 different subset of assets. Well, that's there's a lot of asset classification in this chapter. So before we talk about ordinary asset, capital asset, and then section 1231 asset, right? So now under section 1231 asset, there are 3 different subsets of assets, right? So we have pure 1231 asset, which is land, right? Because land don't depreciate, right? This value doesn't depreciate over time. That's why it's called pure 1231, right? And any gain or loss generated from selling a piece of land is purely from the appreciation or purely from the change in the economic value of the land, right? Not from depreciation, right? So we have the pure 1231 asset, which is land, and then we have section 1245 asset. So this is going to be the majority of the personal asset, right? So it's going to be personal properties or intangible assets, right? And then we have section 1250, which is depreciable real property, right? So this is going to be building, houses, warehouse, real property that can be depreciable, right? All right, so let's talk about and this section 1250, right? So this section 1250 is what I mentioned earlier, in one of the tables, right? But we're going to talk about that in a little bit, right? So section 1231, the pure one, is pretty easy, right? Any gain from selling a piece of land is going to be treated as long-term capital gain, right? So there's not much to discuss there, right? But let's talk about the section 1245, right? So this one is the most complex kind of properties, and let's talk about this, right? So section 1245 properties, is include all the personal properties plus all of the intangible assets, right? So for this asset, as I said, right, when you apply the recapture rule, the depreciation recapture rule, the gain generated from the accumulated depreciation is going to be treated. It's going to be recaptured and treated as an ordinary gain, right? So in this case, the ordinary gain for selling section 1245 property is going to be whatever lesser of either the gain recognized or the total accumulated depreciation or amortization on the property, right? So whichever number is smaller, I'm going to treat that as the ordinary gain, right? So in the first case, if the gain recognized smaller than the total accumulated depreciation, right, meaning there's no portion of gain that is coming from the appreciation in value, right? So in the second scenario here, there might be some portion of gain that is generated from the appreciation in value, right? So we only capture the portion that associated with that is generated from accumulated depreciation, right? And then in that case, any remaining gain is going to be treated as section 1231 gain and going to be taxed at the long-term capital gain at the preferential rate, right? And again, there's no depreciation recapture on loss, sold at a loss, So even sold at a loss, just treated that as ordinary loss, right? So there's no recapture on the loss. So if you have a loss, then just keep it as you can just deduct that as an ordinary loss, right? So for when we sell a section 1245 properties, there can be 3 scenarios that can be happening, So the first scenario is the tax rate going to recognize a gain created solely through depreciation deduction, So there's no gain. There's no gain that are generated from appreciation in value. So that's going to be like this case, right? When we're going to treat the whole gain recognized as ordinary gain, right? And then the second scenario is going to be the tax will recognize a gain created through both depreciation deduction and actual asset appreciation, right? So this is going to be this case, right? When we're going to capture the portion of gains associated or generated from the accumulated depreciation as ordinary income, and then the remaining gain, which is through the appreciation of the asset, as Section 1231 assets, right? And then we tax at preferential rate, right? So that's the second scenario. And then the third scenario is to recognize the loss, right? Meaning they're going to sell, the tax will sell this thing as a loss, and then if that's the case, then there's nothing to be done, right? The loss is going to be treated as ordinary loss, right? So let's look at each case in detail, right? So the first case, recognize a gain created solely through a depreciation deduction, right? So as I said, in this case, there's no gain that is generated by the appreciation in value of the asset. So the whole thing, the whole portion gain, 100% of the gain recognized is artificially generated through depreciation, and that's why the entire gain is going to be treated as ordinary gain, right, under Section 1245. So let's look at this case, and this is one of the, I took this example from one of the homework problems, so I hope that's going to help you guys with the homework, right? So it says in year 0, Longwoods Partnership, the company purchased a machine for $64,750 to use in its business, and in year 3, the company sold the machine for $43,200. Right. So it asks between the date of the purchase and the date of the sale, Long depreciate the machine by $23,900. So what is the amount and character of the gain or loss that Longwoods will recognize on the sale? Right. Let me close it up so make it look bigger. So first of all, we're gonna need to recognize to calculate the gain or the loss recognized by this transaction, right? By this sale, right? So we know the amount realized $43,200, and then in here they always show us how to calculate as an adjusted basis. So the adjusted basis is $40,850, right? So and then accumulated depreciation is $23,900, right? So in this case, the amount realized is going to be $2,350. Right? We take 43,200, subtract 4850, right? So we get 2350 of gain realized, right? So this gain realized, now we compare it to the accumulated depreciation, right? So this gain realized even smaller than the accumulated depreciations, right? So we treated this as, we're going to treat 100% of the accumulated 100% of the gain recognized, right? 100% of the 2350 here as ordinary income, right? And this is going to be taxed at ordinary rate, right? And you can see, because this recognized gain is even smaller than the accumulated depreciation, so there's no there's no portion of this gain is recognized as Section 1231 gain, right? And none of this no portion of this gain is going to be taxed at preferential rate, right? So all right, so that's the first case, first scenario, right? Look at the second scenario. In the second scenario is where the gain is created through both depreciation, and also through the appreciation in value of the properties, right? So let's look at this example, right? So it's really the same example, but just different amount here, right? So we say in year 0, this company purchased a machine for $64,750 to use for business purpose, and in year 3, the company sold the machine for $67,500, right? And then the depreciation amount, accumulated depreciation amount, is $23,900, right? So pretty much the same, it's just different amount of revenue that the firm get from selling the machine, right? So in this case, we know still, right, the adjusted basis is going to remain the same, accumulated depreciation remain the same. So now we can calculate the recognized gain. So we take 67,500 subtract 40,850, and now we recognize a gain of 26,650, right? So in this case, we can see this amount is greater than the accumulated depreciation, right? So that's why there are two portions, right? One portion is going to be recognized as it's going to be generated from the depreciation, and one portion is going to be generated through the appreciation in value of this machinery. So that's why we treat the 23,900 of depreciation, right? This is going to be the portion of the gain that's generated from the depreciation as ordinary income under section 1245, right? And then the remaining, right, the 2750, this is going to be the portion that is generated through the appreciation in value of the machinery. So this value, this gain, this portion of gain is taxed is treated as section 1231 gain, and is taxed at preferential rate, right? So in this case, right, we have the gain can contain both portions, one portion generated from the depreciation and one portion generated from the appreciation in value of the asset, right? So yeah, so that's the second scenario. And then the third scenario is when the firm sell the property is a loss, right? So I think I have to fix this. So this is supposed to be 16,500. Sorry about that. So 16,500. Right. So everything is the same except for the revenue they receive from the proceeds they receive from selling the machine. So my laptop decided to take a break now. I give it a few seconds. Oh, alright. Right, so again, right, the amount of accumulated depreciation is still the same, still 23,900, and so we still have the adjusted basis of 4850, right? But now our amount realized only 16,500, right? So we recognize a loss of 24,350, right? So since the recapture rule doesn't apply to the loss, so the whole amount of 24,350 is going to be treated as section 1231 loss, which can be treated as ordinary loss, right? So all right, so this chart is kind of summarized all of the three scenarios that we just talked about, right? So in the first scenario, since the gain is the first scenario, the gain is even smaller than the amount of accumulated depreciation, right? So we treated the whole amount as ordinary income, right? And in the second scenario, now we have the gain is greater. The gain is greater than the accumulated depreciation amount. So we treated the portion of gain that is generated from depreciation as ordinary income under section 1245, and then the rest, the remaining gain, right? This is the gain that is generated from the appreciation in value of the asset. So we treated this as section 1231 gain, and we tax this gain at the preferential rate, right? And then the third scenario, again, well, in this scenario, there's no gain, right? That's the loss. So the realized amount is even smaller than the amount realized even smaller than the adjusted basis, right? So that's why we recognize a loss. So this loss can be treated as section 1231 loss because the recapture rule doesn't apply to loss, right? So this loss can be treated as ordinary loss, right? So and please disregard the numbers here, but this chart is created using a different example, you know. But just focus on the shape of the chart here. So the chart kind of summarizes our all of the three scenarios that we just discussed. Right. All right. So let's look at another example here. Right. So it says this company they sell a machine with an adjusted basis of $6,000 for $10,000. So the adjusted basis is $6,000 and the realized amount is $10,000. Right. And depreciation taken on the machine amount to 25 to 2,500. Right. So it asks what the amount of gain is recaptured as ordinary and what amount of gain is 1231 gain. Right. So the amount realized is $10,000 and then adjusted basis is $6,000. So we have a gain realized of $4,000. Right. So now you can see this $4,000 compared to the accumulated depreciation is 2,500. Right, it's bigger, right? So $2,500,000 of the 4,000 is going to be treated as ordinary income, right? And then 1,500 from this 4,000 is going to be treated as Section 1231 gain. It's going to be taxed at preferential rate, right? So, yep, like what we just talked about, right? So 2,500 is going to be treated as ordinary income, right? Because it is subject to the depreciation recapture rule, right? And then the 1,500 is going to be treated as Section 1231 gain. It's going to be taxed at the preferential rate. All right. So that was Section 1245, right? And that was the most complex one. So let's talk about Section 1250, right? Which is the other type of subsection asset, right? So remember, Section 1231 has three sub-classification, right? We have pure Section 1231, which is the land, right? Because land doesn't depreciate, right? And we have subsection 1245, so this includes personal properties and intangible properties, right? And then we have subsection 1250, which is depreciable real properties, right? So we have building, a warehouse, those kind of stuff, right? So, all right. So now let's talk about subsection 1250 properties. Right. So before 2017, there's the section 1250 recapture rule, but after 2017, with the new law came out. There's no such thing anymore, so section 1250 recapture rule technically it's not effective anymore. So let's not talk more deep into that, However, that's the new law, it's kind of new rule, it's kind of acted as like a modified version of the recapture rule. And it's called Section 291, depreciation recaptures, and this rule only applies to C corporation. Right. So, and then there's another rule that kind of apply to individual taxpayer as well, but we're going to talk about that in a little bit. Right. But let's look at this Section 291. Right. So under Section 291, C corporation selling depreciable real property have a recapture as ordinary income, 20% of the lesser of the recognized gain or the accumulated depreciation. Right. So I'm not gonna talk more about this, but let's look at one of the example here. Maybe it's gonna give you guys a more clearer view of this Section 291. Right. So this example, it says, suppose that this company Titan was organized as a C corporation. So so now it's a C corporation. If in all the previous, all of the other example, this company is a sole proprietorship, right? Or a partnership, right? So it's a flow-through entity. But let's assume that now it is a C corporation, right? And it sold its existing warehouse, and let's assume that the company sold the warehouse for $350,000, which it purchased initially for $275,000, and assume that the company has deducted $15,000 of straight line depreciation deductions, as of the date of the sale. So what is the gain recognized on the sale, and what is the characteristic rate? So we can easily calculate the adjusted basis rate, and then we can calculate the recognized gain. Right. So we have adjusted basis to $60,000, and then we can calculate the gain recognized, which equals to $90,000. Right. So the Section 291 rule is say that you have to recapture 20% of the lesser of the recognized gain or the accumulated depreciation. Right. So in this case, the accumulated depreciation is $15,000, and the recognized gains is $90,000. So we have to recapture 20% of the accumulated depreciation, right, which is less than the recognized gain here. Right. So we take 20% times $50,000. So we have to treat $3,000 as ordinary income under Section 291, and then the rest, which is $87,000, we can treat it as Section 1231 gain, and this $87,000 is going to be taxed at preferential rate. All right. So So I just want to give you kind of like an introduction about this Section 291. Alright, but it's pretty basic, pretty simple, so let's move on. Alright, so that was for C corporation, right? So what happened to individual taxpayers, or flow-through entities, how can they recapture their Section 1250 gain? Right? Now that Section 1250 gain is not available anymore, right? So there's there's like I guess you can say there's an alternative to the Section 1290 gain that has been expired, right? So we say so for individual taxpayers, or for taxpayer who has a flow-through entities, the gain that would be for the gain from the sale of Section 1250 real property, so the gain from the sale of a building, let's just say that, right? The gain from the sale of a building, that would be 1245 recapture if the asset were 1245 property. Is called unrecaptured 1250 gain, right? And this gain generated from depreciation is not treated as Section 1231 gain, right? So basically, it's a assume for a second that the building is treated as a 1245 asset, right? So you say that the gain that would be 1245 recapture if the asset were 1245 properties, is called unrecaptured 1250 gain, right? And instead of treating this gain, this unrecaptured 1250 gain, instead of treating it as the capital, long-term capital asset, a tax at preferential rate, instead of doing that, the unrecaptured 1250 gain is going to be taxed at 25%, right? So still, it is not ordinary income. It's not treated as ordinary income, but it's also it is not treated as Section 1231 gain either, right? It has its own kind of tax rate, which is the maximum rate is going to be at 25%, right? So compare this to Section 1245, right? So in Section 1245, the recapture gain, right, meaning the gain generated from the depreciation, is going to be treated as ordinary income, right? But for building, for real property, for depreciable real properties, the gain generated from the depreciation of the building is not treated as ordinary income, and also not treated as Section 1231 gain. It is treated as unrecaptured 1250 and taxed at its own kind of tax rate, tax at the maximum tax rate of 25%. Right. So let's look at this example. Hopefully, it's kind of clarify the situation a little bit. All right. So again, say this company, right, and now this company is still now this company is a flow-through entity again. Right? It's not a C corporation. Right? So assuming that Titan bought its warehouse for $275,000, depreciated it for $15,000, and sold it for $350,000. What is the amount and character of the gain that Titan, right? And those Steve is the owners. Right? So this now is a flow-through entity. Right? What's the character? What's the amount? What's the character of the gain that this company reports on the sale? Right. So we again, right? We can easily calculate the adjusted basis and the recognized gain, right? Which is still $90,000 of recognized gain, right? And we have $50,000 of accumulated depreciation, right? So out of this $90,000 gain, $15,000, which is generated from the accumulated depreciation, right, it's going to be treated as unrecaptured Section 1250 gain, and this is going to be taxed at a maximum of 25% tax rate. And as the remaining $75,000 is going to be treated as Section 1231 gain, which is going to be taxed at a preferential rate. Right? So again, this $50,000 generated from depreciation is not treated as ordinary income, like when we do it, like what we do to Section 1245 asset. Right? It is not treated as ordinary income. It is treated as a class of its own, pretty much. Right? And it taxed at a different tax rate. So let's look at how we're going to tax this gain. Right? So for the $15,000 of gain, we're going to tax at 25%. Right? And then the remaining $75,000 we tax at 15%. Right? This is a preferential tax rate. Right? So again, remember that, right? This unrecaptured 1250, it is not ordinary gain. It is a class of its own, right? And it has its own tax rate applied to it. All right. Whew, all right. So that was so what we just talked about was all of the subsection of subclassification of Section 1231 gain of Section 1231 assets. You know. So so let's move on. Right. So let's talk about some other provisions that affecting the the rate of the tax rate, right, of the gains. So there's another section called Section 1239, which focuses on how to treat the gains from the sale of depreciable property to related persons. Right? So as we mentioned about this in previous chapters, right? Sometimes people are going to try to find a way to avoid paying tax, right? And they're going to try to, sell stuff to related people, to their family members, maybe to also some related parties, and then maybe record a gain or record a loss, to deduct something, right? But still, the asset is still remaining within that whole conglomerate of taxpayers, right? So Section 1239 is created to discourage people to do that, right? So under Section 1239, it says that all gain recognized from selling properties, from selling a depreciable properties to a related person is going to be recognized as ordinary income. Right? So none of the gain is going to be taxed at preferential rate. Right? All of the gain is going to be taxed at ordinary income rate. And then the sellers, right, is required to recognize the ordinary income also for the depreciation deductions that the buyer will receive in the future. Right. So this is a bit different from the depreciation recapture rule. Right? So the depreciation recapture rule, they say that, well, okay, the seller is going to be recognize the depreciation deductions as in the past, right, that they already deduct as ordinary income, right? But for section 1239, they say that seller have to recognize the deduction, the depreciation deduction in the future that the buyer will receive in the future as ordinary income, because under the IRS view, under the Congress view, the buyer is still a related person to the seller, so they're gonna treat them as a similar, as the same group of taxpayers. So whatever deduction, depreciation deduction that the buyer recognize or receive in the future, the seller have to recognize it, right? All right, so so that was about for individual taxpayers, right? So what happened to corporate or C corporation, right? So if the C corporation sell the property to some associated, some related person or some associated entities, they also have to do the same, right? So what can be considered as a related party, so in here we have kind of like a definition of a related party, right? So related party include individuals and his or her controlled more than 50% owned corporation, or partnership, or taxpayers, or any trust in which the taxpayers or the taxpayer's spouse is the beneficiary. Right? So it's very broad, right? The definition of related party or related person is very, very broad, right? And then still, it also includes two corporations that are members of the same control group. Right? A corporation and a partnership, if the same person own more than 50% of both entities. Two S corporation controlled by the same person, and an S corporation and a C corporation controlled by the same person, right? So again, the definition of related party is very broad, right? So that's why it looked like Congress and the IRS, they really want to discourage people to engage in this kind of activities, engage in related person or related party transactions, All right, so what happened to my slides? Alright, so let's look at this example, and then after example, I'm gonna hand this video here. Right? So let's look at this. So it's a Luke sold the building and the land on which the building sits to his wholly owned corporation, Studmont Corp, at the fair market value. The fair market value of the building was determined to be $465,000. Luke built the building several years ago at the cost of $435,000, and Luke has claimed $64,000 of depreciation expense on the building. The fair market value of the land was determined to be $275,000 at the time of the sale, and then Luke purchased the land many years ago for $193,500. So the question asks what the amount and the character of Luke's recognized gain or loss on the building and on the land. Right. So remember, there's two things here. Right? There's building and land. So the building sit on the land, but they're going to be treated as different things, right? Because they are two different class of assets. Right. So let's see. And again, this question is I took it from your homework, So hopefully it helped you guys a little bit in your homework. All right. So okay. So let's consider the building first, right? So for the building, we know the market value is $465,000, so that's going to be the amount realized, right? For this $465,000 of realized amount, and then the initial basis was $435,000. The accumulated depreciation is $64,000. So from there, we know the adjusted basis is $371,000, and we know the gain is going to be $94,000, right? So this gain the recognized gain 94,000, all of it is going to be treated as ordinary income, right? Because in this case, this guy is selling the whole thing to the corporation that is owned 100% by him, right? So definitely this is a related party transaction, right? So yeah, so because of that, under section 1239, 100%, the whole amount of 94,000 is going to be treated as ordinary income, right, and taxed at ordinary rate. All right. So what happened to the land, right? So the land is a different case, right? So again, we know we can calculate the adjusted basis for the land, which is at 193,500, right? Because there's no depreciation, so the adjusted basis is going to be the same as the basis, the initial basis, right? And then we know the amount realized is 275,000. So we know the gain is going to be $81,500, right? And then since this is a land, right, land is the pure 1231 asset, so the whole amount of 81,500 is going to be treated as section 1231 gain, which is going to be taxed at preferential rate, right? All right, so that's it for today. For this video, I'm going to end the video here, and I'm going to pick up from here from the next video. All right, so I see you guys in the next video.